Strong economies don't collapse because they look weak. They collapse because strength often hides fragility. From the outside, everything appears stable. Growth is positive, employment is high, markets are calm, institutions signal confidence. The numbers say the system is healthy. That is precisely why collapse feels so shocking when it finally arrives. The warning signs were never absent. They were simply invisible beneath the surface. Economic strength is usually measured through outcomes: GDP growth, stock market performance, low unemployment, rising consumption. These indicators describe motion, not structure. They tell us how fast the economy is moving, not how well it is built. An economy can expand rapidly while quietly becoming more brittle with every step forward. The logic begins with incentives. When an economy performs well for long enough, behavior changes. Risk feels unnecessary to consider. Buffers appear wasteful. Leverage looks efficient. Both public and private actors learn that stretching assumptions is rewarded. Borrowers take on more debt. Lenders accept thinner margins of safety. Governments postpone hard reforms. None of these decisions are reckless on their own. Together, they reshape the system into something far less resilient than it appears. Strength creates confidence, and confidence alters judgment. When institutions believe they are operating within a strong economy, they underestimate tail risks. Financial models rely on recent stability. Policymakers focus on sustaining momentum rather than questioning foundations. Markets price assets as if current conditions are permanent. Over time, the system becomes optimized for growth rather than survival. This is where the distinction between strength and resilience becomes critical. Strength refers to performance under normal conditions. Resilience refers to behavior under stress. Strong economies often lack resilience because they have not been tested recently. The absence of shocks becomes proof that shocks no longer matter. Safety margins shrink quietly as complexity increases. Leverage plays a central role in this transformation. Debt amplifies both gains and losses. In a strong economy, leverage feels manageable because income, asset prices, and tax revenues are rising. Debt servicing looks easy. Balance sheets appear healthy, but leverage does not reveal its danger during expansion. It reveals it only when conditions change. By then, adjustment options are limited. History repeatedly demonstrates this pattern. Before major collapses, economies rarely look fragile by conventional measures. They look successful. Credit is widely available. Asset prices are elevated. Financial innovation promises better risk distribution. Growth feels self-sustaining. When the break occurs, it is often triggered by something relatively small: a slowdown, a policy shift, a price adjustment. The trigger matters far less than the structure it exposes. Strong economies also tend to accumulate hidden imbalances. Capital flows concentrate risk in certain sectors. Housing markets absorb excess liquidity. Corporate balance sheets rely on cheap financing. Governments expand commitments assuming favorable conditions will persist. These imbalances are not immediately visible in headline statistics. They emerge slowly, dispersed across institutions and time. Another critical factor is timing. The longer an economy avoids crisis, the more it forgets how crises form. Institutional memory fades, regulations loosen. Risk management evolves to match recent experience rather than historical extremes. This creates a feedback loop where success erodes caution. By the time vulnerabilities become obvious, reversing them requires painful trade-offs. Labor markets can reinforce this illusion of strength. High employment supports consumption and confidence even as productivity growth slows. Wage pressures mask declining margins. Employment data looks strong right up until conditions deteriorate rapidly. When downturns finally arrive, they often accelerate faster than expected because the system has been stretched too tightly. Political dynamics add another layer. Strong economies generate expectations. Voters demand continued growth. Leaders avoid decisions that might slow momentum. Structural reforms are delayed because they appear unnecessary during good times. Debt accumulation feels tolerable. Fiscal discipline weakens quietly. These choices are rational within short political cycles but destabilizing over longer horizons. When collapse finally begins, narratives shift abruptly. What was framed as strength is reinterpreted as excess. Confidence becomes complacency. Innovation becomes fragility. Policymakers respond with emergency measures designed to stop immediate damage. These actions may stabilize the system, but they do not erase the logic that led to failure. The collapse was not caused by weakness, it was caused by a version of strength that ignored its own limits. This is why collapses often feel sudden. The system does not gradually decline in visible ways. It operates normally until a threshold is crossed. At that point, feedback loops reverse. Liquidity dries up, confidence vanishes, leverage magnifies losses. What once sustained growth now accelerates contraction. Understanding this logic reframes how economic health should be evaluated. The most dangerous systems are not those that look unstable, but those that appear invulnerable. Strength without resilience is temporary. Stability without margins is fragile. Growth without adjustment accumulates risk. Strong economies still collapse because strength changes behavior. It reshapes incentives, it reduces caution, it encourages structures that perform well under ideal conditions but fail under stress. The collapse is not a contradiction of strength, it is often the consequence of how that strength was built.